This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Hey, great episode today, episode 350.
Yep. We welcome Scott Cederburg back to the Rational Reminder Podcast for the third time.
Mm-hmm.
We've had two episodes, one on this same paper, and now we're having it back to discuss the updated version of this paper, which, I mean, they did a pretty significant overhaul of the original, just based on the huge amount of feedback that they got from, as Scott talks about at the end, from other people in academia and from practitioners. So they've added, like, the way that I describe it is they added a ton of the what if scenarios. Because there's so many things where people are like, okay, well, your result says this, but you're not modeling this, or you're not considering this, and that will change your result. So they modeled so many of those what if scenarios, like what if valuations are high? How does that change the result? What if you allow leverage? What if correlations, or how do correlations over time affect things? They modeled different spending strategies and looked at how that affects asset allocation. They looked at optimizing the asset allocation in each year of the simulation instead of having an optimal fixed allocation for the full life cycle.
Yep.
And they looked at how that changes results. What else was there? If the U.S. was special.
Yeah,
like
or how
the
important
U.S. experience is. What's that?
Or how important U.S. equity returns were if you're an international, if you're an investor from another country, and then the international component of your portfolio is partially U.S. equity. How important is that to the result that you want to hold a lot of international equity, right? That was really interesting for me. Yeah.
Does the U.S. drive the high international stock allocation? Because it's had such a good outcome. And then the U.S. special case was like, is the U.S. special in a way that suggests it should have high returns in the future, similar to the past? And so they did one specification where they hold the probability of U.S. being special fixed at some amount, so that percentage of their bootstrap draws come from the U.S. sample, to see how that affects optimal portfolio allocations. I don't know, there's other stuff too, but we talked through all of those changes that they've done to the paper and how it affected the results. I don't know, what do you think, Mark, of the overall conversation?
That was great. Like, surprising, I think, for me in a lot of ways. We were chatting with Scott at the end of the episode, and obviously you understand and have read the papers more frequently than I have, and I've largely just taken the synopsis of Scott's work. So some of the questions, as I was asking him, I didn't know what the answer was going to be, and you obviously did, Ben. And so my mind got blown a number of times throughout the conversation, whereas you already knew what the answer was going to be. So it was a really fun conversation for me, because I thought I knew what the answer might be, or at least the direction that the answer would take, and I was surprised in a lot of cases. So no, it was a really, really good conversation. I learned a ton, and I think listeners are going to just love it.
Oh yeah. I mean, our last couple of episodes with Scott have been, I think, some of the most discussed episodes in the Rational Reminder community, just by like the number of comments, and those threads are still ongoing with people discussing the implications of the research and the research itself, like discussing the methodology and the data sample and all that kind of stuff. So it's an important paper, at least for the amount of discussion that it's created. And I think that adding all of these, all of the comments and criticisms that they have addressed with additional analysis, I think really adds a lot to the overall discussion. We asked Scott at the end if anything has surprised him going through all that additional analysis, and I loved his answer that he was mostly surprised by how resilient the results are to running all of these alternative specifications, or different sets of assumptions or whatever. Like, things change a bit, and we talk about cases where they do change, but it's a pretty stable result, which is pretty cool. So for people who don't know who Scott is, he is an associate professor of finance and the Thomas C. Moses Endowed Professor in Finance at the Eller College of Management. He earned his PhD in finance from the University of Iowa, and his research focuses on issues related to long horizon investment outcomes and retirement security, return predictability, and mutual fund performance. He's been published in lots of top journals. And as we discuss at the end of this episode, that's the next step for this paper, is to submit it to top journals and hope it gets accepted somewhere. Anyway, I think that's enough for the introduction. So we're talking about the paper Beyond the Status Quo, a critical assessment of lifecycle investment advice. and a new version of that paper by the time this episode comes out, a brand new version, like at the time that we're recording this episode, which is a couple weeks before it comes out. That version of the paper has not been published on SSRN yet, but when this is out, it will be up. So if you haven't taken a look at that yet, I recommend doing so, because there's lots of neat little nuggets in there.
Great.
All right, let's go to the episode. Scott Cederburg, welcome back to the Rational Minder podcast.
Yeah, thanks for having me back again.
Yep, excited to have you back. All right, so you've got this new draft of this paper that we've talked about before, which we're going to talk about. But as a quick refresher, since it's been a while and you've obviously made changes to the paper too, can you describe your data setup and the kind of headline findings from the paper beyond the status quo?
Yeah, so we're doing a lifecycle asset allocation paper. So we're really looking like, you're saving throughout your working years and then going to be spending down in retirement, and just, the very practical question of how should you be investing during your life. There's lots and lots of papers that have been in this literature looking at this particular question. They study a wide variety of issues, like labor income, how that interacts, health risk, all these sorts of things. So kind of how we see ourselves fitting into the literature is that we're going to be very, very careful in how we're treating the data and just the investment opportunities that you have. And so that has a few different aspects. So one, it's very common in this literature to just say, oh, you have access to stocks and bonds. So it's kind of domestic stocks and bonds. So we've explicitly added in international stocks. That's going to turn out to be very important for us. So we have 4 different asset classes with domestic stocks, international stocks, bonds, and bills. It's also true that the literature is kind of very US centric. We think that there's, relatively little kind of evidence in the US data about the types of horizons that we're thinking about. Like you might have 75-year horizon or something when you start saving. And so we use our comprehensive data set of developed countries. We have 39 countries, 1890 to 2023. So we have, over 2,650 years worth of country years worth of data to kind of bring to the question. And then finally, a lot of the papers will either, say maybe returns are normally distributed, or maybe pick a couple of state variables that might affect expected returns. So we're going to kind of depart from the literature and use a block bootstrap approach. And it's going to allow us to kind of keep a lot of the features that are in the data without having to take a strong stance on like what investors, what particular aspects of returns investors might be most interested in. And then kind of the headline finding is, you should never own bonds. You just invest in stocks internationally diversified throughout your entire lifetime.
And sorry, can you just define what you mean by domestic and international in your data setup?
Yeah, sure. So we're taking the perspective of an investor in a developed country. And so then they're going to have access to their own domestic stock market. They have international stocks, which is going to be a valuated basket of everything else in the world. And we're going to have all the currency conversions and things like that that are necessary for that. And then government bonds and government bills from your local market as well. And so we're, the kind of the broad perspective that we're taking in the paper is that developed country returns are developed country returns. And so, like the experiences of German investors may be informative to me as an American. So that's kind of the stance that we're taking. It's also important to note that all of our returns are going to be in real terms. So everything is after inflation. And that's also, I think, very important for thinking about, for example, like how risky is a bond? How risky is a nominal bond? That very much depends on whether you're in nominal or real terms.
Great.
Yeah, that definition of domestic, international, and international is something that I've found people struggle to grasp when I'm talking to them about your paper, because people think of domestic as like the US usually. Yeah. And you got some misguided criticism like based on that, saying, well, they focused on US stocks, but domestic in this case is not US. It's like whatever, using your bootstrap method, kind of like a representative domestic country.
Yep.
Which I think makes a ton of sense. Can you talk a little bit more about, you mentioned it with the long horizon and the relatively limited sample of US data, but can you talk about why the bootstrap procedure is necessary for what you're doing?
Yeah, so we think it's a good approach that so there's very important patterns in returns, and especially what we might call like time series dependencies. So we know, for example, that volatility kind of clusters in time. You're in a bunch of volatile months in a row, and then you'll have a calm period. There's important properties of like stocks where historically there's been mean reversion in returns kind of across all these developed countries. We kind of consistently see mean reversion. So a large stock market crash, stocks don't always bounce back, but there's a tendency for stocks to bounce back. And then if we have a really hot period in stocks for an extended period of time, like the 1990s in the US, the next decade doesn't have great returns. And so there's this tendency to have mean reversion in stocks. And so what we can do with the bootstrap, and there's all sorts of other things that are important about returns. There's skewness, there's kurtosis, like fat tails, all this sort of stuff. And what the bootstrap is going to do is just sort of let the data speak and what do returns look like. And there's a block bootstrap aspect of this where to try to preserve these time series tendencies, we're drawing on average about 10 years worth of consecutive data from the same country period. So we're going to try to basically, if there is a stock market crash, we're likely to also pick up the period where it may have been able to bounce back. So we just, use the block bootstrap to kind of just try to preserve as well as we can what are the properties of the data, and then we don't really have to take a strong stance on like what are the particular aspects of the data that we're trying to capture, what's going to be important to investors, everything like that. And so I think a really important part of this, kind of an illustration of thinking about long-term investing and the importance of maintaining these properties is if we look at bonds versus international stocks as a way to diversify away from just pure domestic stock investments. If you look at a monthly level, bonds have relatively low volatility and they have relatively low correlation with stocks. And so it looks like this thing that diversifies us pretty well. And our kind of classroom examples of mean variance frontiers and everything is always kind of bonds and stocks. With a lot of diversification benefits, but bonds don't really earn very high returns. Like in our sample, the average real return is 1% per year on bonds, versus international stocks have a 7% per year average real return. And so there's this huge difference in the potential reward. You need to be getting a lot of diversification benefits out of bonds. So if you look over the longer term, going beyond monthly level and think about like a 30-year period or something, all of a sudden the risk of bonds grows over time. So there tends to be continuation in bonds. The worst thing that you have in nominal bonds is an inflationary rising interest rate environment. But if you have an inflationary rising interest rate environment, you tend to kind of stay in that environment for a while. And so on a per period basis, the risk of bonds at a 30-year horizon is like 2.3 times the 1-year horizon. So the variance grows with horizon. Versus international stocks with the mean reversion, it actually gets down to about 0.75 times the 1-year variance on a per period basis. And so stocks are getting safer over the long run. Bonds are getting riskier. And the other thing is that bonds actually become more correlated with domestic stocks than international stocks are if you get to a longer horizon. So you're kind of losing these diversification benefits that you initially think that you have with the bonds as your horizon grows. And there's just not really the reward there, in terms of the average return to make them that attractive. But that's something that with our approach, we can sort of see that in the data, and we didn't have to kind of pre-specify that that's what we wanted to find.
Wow. So the paper is called Beyond the Status Quo. Can you talk about how your results differ from the status quo?
Yeah, so the status quo at this point really is target date funds. So target date fund, you might see something like a 2050 fund or something, and that 2050 is supposed to be your target retirement date. The one that we look at in our paper, it's major investment firm, it'll have you 90% in equity split across domestic and international early in your life. And then as you get towards retirement, it decreases that. And it ends up parking you basically like 83% bonds and bills throughout much of your retirement. And so this has become enormously popular. It's the default in, like, according to Vanguard, it's the default in 98% of employer plans. There's like, I think it's 83% of people with Vanguard plans own at least one target date fund, and 58% have all of their money in a single target date fund. So that's like 3 out of 5 investors are just they're just going to do the default TDF, and so that's really the status quo at this point. You know, our baseline result of be all equity throughout your entire life is going to be very different from being 83% in bonds and bills during retirement.
Can you talk a little bit more about why your findings with the data set that you just described would be different from somebody just looking at the US data, as many other people have done?
Yeah, so the US has had a really good run, obviously, over this time. So there's always kind of this issue of, I guess what we would say is like ex ante versus ex post. Like before the fact, did we know that the US was going to have this run, or did it end up being basically better than people may have expected? So, with the US, we have, I think, a relatively short sample of data. We have 130 years of data in our paper, but if you're a 25-year-old couple, there's a pretty, not a great chance, but a non-trivial chance that one of you makes it to 100. And so you kind of have this 75-year horizon, and we don't even have 2 non-overlapping 75-year periods of US data. So it's relatively small. And then there's, we've seen a big valuation increase in the US over this period. I guess there's some question of whether that was expected before the fact and whether it's sort of sustainable to repeat that. And so we see around the literature, people do various kind of ad hoc adjustments sometimes. So they'll use US moments, but then subtract 2% from the mean of stock returns or something, just to try to say like, let's maybe have it reflect a little bit more like what's a forward-looking expected return. I guess our strategy is not all of the countries in our sample have had this kind of rosy outlook. There's been a couple of different times in our sample, for example, like the UK in 1890 and Japan in 1990. Those were the 2 biggest markets at the beginning of those periods, and then over the next 30 years, they have pretty substantial negative real returns on stocks. So that's kind of our different approach to it.
Makes sense. So what evaluation metrics are you using to compare the different investment strategies in the paper?
Our primary one at this point is expected utility. So it's just a way of kind of measuring the overall well-being, and we're getting utility over kind of the monthly retirement consumption that you have, as well as a bequest upon like the death of the last survivor of the couple. So that's kind of our primary metric. And then to get intuition on what's actually driving this, we look at 4 other outcomes. So it's, which strategies are generating the best kind of retirement at wealth, like a distribution of retirement at wealth, what's providing the best retirement income, what's giving you the least chance of running out of money in retirement, and then how large is the bequest that you're actually able to give. So we do that as kind of support of, why our investors are choosing this particular portfolio.
You mentioned all equities internationally diversified. Can you talk more specifically about what the optimal base case portfolio looks like?
Yeah, so in our base case, we're going to be looking at fixed weight strategies where people are going to just invest and hold those same portfolio weights through their entire life, rebalancing. And the optimal is 33% domestic stocks and 67% international stocks, 0% bonds, 0% bills. The exact mix of we kind of do some sensitivity analysis to the exact mix of domestic versus international. And like the utility is kind of flat, relatively flat over a fairly wide range there. So there's not huge differences between, if you want to be, say, 15% domestic and 85% international, or, maybe you're a US investor and you feel more comfortable at 50-50 or like 60-40 US international, something close to market weights. That's not going to be like really bad deviations for you. Versus kind of adding on bonds and bills, the investors get fairly grumpy fairly quickly when you do that. So
where are the limits on that? Like if someone wanted to have 2% domestic, like does it start to matter at some point?
on that end of the spectrum, it doesn't matter a ton. Like 2% isn't going to kill you according to the analysis anyway. Like 2% is not going to kill you. 100% domestic is a bit of a problem. So, or 80, 90, 100% domestic. That's when the utility losses really kick in.
So how did you arrive at the optimal base case strategy?
Yeah, so we're optimizing expected utility, and we just use kind of a brute force grid search algorithm where you effectively just calculate the expected utility at every single combination of weights, and then figure out which combination gives you the best. So which set of weights gives you the highest utility.
Wow. So you tested a lot of portfolios.
Yeah. We've used some processor time on this paper.
How does the optimal base case that you just described, how does that perform relative to the 60-40 benchmark and the target date fund benchmarks that you use?
Yeah, I guess one way of summarizing this, so we have in the base case, our couples are going to save 10% of their income throughout their working years. And we can calculate something that we call like an equivalent savings rate, where if you had a different strategy, how much would you need to save with that strategy in order to get the same expected utility, the same overall well-being as we have with just the 10% savings rate with the optimal strategy. And so the 60-40 strategy, 60% domestic stocks, 40% bonds, this is also a fixed weight strategy. And so by definition, the optimal strategy is going to be better than this one. And we find that it's significantly better. You would actually have to save 19.1% during your working years to get the same utility as 10% with the optimal strategy. So you almost have to save twice as much. Versus the TDF, there's actually a chance that the TDF can beat the optimal strategy because the optimal strategy is restricted to fixed weights. And the TDF is, we're building on theory to say, hey, there should be this age-based approach that you're going to back off bond, or you're going to back off stocks as you get older. But what we find is that it's like really underperforming. I think you have to save like 61% more. So it's like an equivalent savings rate of 16.1% in the TDF to get as much expected utility as just going 100% stocks. So it's pretty large. I mean, if you think about having to save an extra 6% of your income every year for your entire life, I mean, it's a pretty large economic magnitude, I think.
I really like that metric, how much more you'd have to save, because it works with the utility, but then it's super intuitive for someone that maybe doesn't even understand utility. Like what you just said, you have to save 6% more of your income to get the same expected outcome. I think that's such a nice way to do it.
Thanks.
Yep. Okay, so people will say that it's sort of obvious, right? That 100% equity portfolio is going to outperform a portfolio that's not 100% equity over the long run, right? So how does the optimal strategy perform relative to the benchmarks and the worst simulated outcomes?
Yeah. So like, as you mentioned, like if we're thinking about wealth accumulation, it's like, yeah, pick the highest expected return assets. And it's really no surprise that like on average, you're going to have more money at retirement if you're 100% equity than if you're anything below 100% equity. So that's pretty obvious. What's interesting, I think, once you actually start getting into it, and again, talking about things in real terms, once you start getting into it, the all equity strategy is safer than something like a TDF. So even the distribution of wealth at retirement, all the percentiles are better. So it's not only that the average is better, the median is better. or that the right tail of good outcomes are better. It's that the first percentile, the way left tail is better with the all stock strategy than it is with the TDF. And so you're just getting a better distribution of potential outcomes with stocks. And then this extends into retirement. So, the thing that people are going to be scared to death about is being 100% stocks in retirement. But if you look at the metrics, if you're actually measuring things based on retiree outcomes, like the consumption that we should be caring about, then the stock strategy is still safer. So like the TDF, we're using the 4% rule for with retirement withdrawals. So 4% rule, if you have $1 million when you retire, you would initially withdraw $40,000 that year, and then inflation adjusted $40,000 each year throughout retirement. And so just kind of as a simple rule of thumb. So, with the 4% rule, there's some chance that you're going to run out of money, though. You have a string of poor performance, or you live for long enough, you run out of money. And the TDF, your odds of running out of money are almost 20%. And with the all stock strategy, it's like 7%. And we can delve into that a little bit more, but it's really it's like two main things. It's the couples who live a long time. If you live for another 40 years after retiring and you're 83% in fixed income, it's just going to be really tough to generate enough additional wealth to make it that far. And then the other possibility is that you hit an inflationary period in retirement. And even if we look recently, like 2021, 2022 in the US, like 10-year treasuries over that 2-year period in real terms lost 30%. And so if that's where all your wealth is and you lose 30% in a year, and then bonds don't bounce back like stocks do. If stocks go down by 30%, keep on holding, then there's at least a better than even chance that they're going to kind of bounce back over the next few years. But with bonds, that's just kind of gone. And so, it's really like we can even say like what happens if stock returns during your retirement period are bad. And it's still better to be in the all equity strategy with the international diversification than it is to be in the TDF. Because if stocks do badly do poorly over a long period, bonds also tend to do poorly over those same periods. And so just kind of no matter how we split it, we kind of can't find a spot where it looks like stocks are significantly riskier than bonds. So what's really surprising, I think, about the results is the degree to which stocks, like 100% equity portfolio, is actually better at capital preservation and not just that wealth accumulation part.
Wild.
Yep, that is wild. So the base case portfolio, as you mentioned, has this fixed allocation. One of the things you look at in the most recent draft of the paper is how the optimal allocation changes when you let the household vary their portfolio weights through time. Can you explain like how you're doing that optimization and what the result looks like?
Yeah, so we're letting the couple choose a different set of weights at every age. So, they can invest one way at age 35 and a different way at age 75. The optimization's a little bit tricky because your optimal portfolio weights at age 35 depend on what you think you're going to do at age 75 or how you're going to invest at age 75. And your weights at age 75 depend on how you invested at age 35. And so you kind of have to find the jointly optimal set of weights that maximizes the overall retirement utility, but that every decision at every age is consistent with all the other decisions that you make throughout your entire life. And so we're doing this iterative optimization approach where we kind of start it and say, oh, you're going to do this strategy, and then we just keep on in every step. Like we look at each particular age, but if we're looking at age 36, we're going to tell that 36-year-old like, well, here's your optimal strategy at all the other ages, and then what do you want to do at age 36? And so you just have to kind of iterate through until it converges to an optimal solution. So when we do that, it ends up being largely similar to our fixed weight approach. So you're 99% in equity on average across all the ages, and then 1% in bonds and bills. And if you look across time, basically up to retirement, it's 100% equity. There's a little blip around retirement. So at age 65, the investor puts 27% in bills and then mixes the rest of it in domestic and international stocks. But that's relatively short-lived. I think by 68, they're back over 90% in stocks, and basically by age 70, they're basically 100% stocks again for the remainder of their life. So it's just kind of this short-lived blip of getting some money off the table right around the retirement period is kind of the only difference between our full life fixed weight design and then this age-based design.
That's a big deal though, man. Like from a financial planner's perspective, the difference between having a client 100% in stocks forever, and we have more questions to dig into this in a sec, but
Yeah.
The difference between that and somebody who's going to be 27% in bills at retirement and then holding bills until age 70, that's no joke.
Yeah.
Like if we're talking to a client, that's a very significant difference.
Yeah.
Anyway, we've got more questions to dig into that, but that's a super interesting finding.
Mm-hmm. Yeah. So how significant were the gains or the benefits from the optimal time varying strategy that you just described?
Yeah, so if we go back to this kind of equivalent savings rate, so we have a 10% savings rate with the optimal fixed weight strategy. If you do this age-based strategy, you can reduce your savings all the way down to 9.93%. So it's basically like for every $1,000 you're going to save, you can buy a cup of coffee at Starbucks with the amount that you sort of can reduce your savings by. So it's a relatively low kind of economic significance.
Makes sense.
Yeah, that's interesting in two different ways, because it's interesting that it doesn't change things much, but it's also interesting that if somebody really wanted to hold cash early in retirement because it made them feel better, it doesn't have necessarily a huge detrimental effect, it doesn't sound like.
Yeah. I mean, they are picking this as the optimum, and so it is increasing their utility by holding
Right.
that cash there. But for us, it was kind of a reassuring result where it's very difficult to do kind of these in this setting, given that we have the bootstrap, we can't do some of the traditional methods of dynamic optimization. And so we kind of went through and looked at different elements of, hey, what if we let them choose an optimal retirement age, for example, or different things like that. And just to see whether we had sensitivity basically to, if we have static optimization as our base case, how bad of a base case is that effectively? And kind of everywhere we look, it's like, it's not that bad. I mean, like the fixed weight strategy is so close to this age-based strategy, for example, that it's just, it makes that initial analysis, I guess, valid in some sense.
Yeah, okay, that makes a lot of sense. How does the time varying optimal portfolio, how do those allocations change when you abandon the block bootstrap and just assume that returns are independent and identically distributed?
Yeah, there definitely becomes a bigger role for bonds and bills in retirement. So they're still choosing all equity up to retirement, and I believe in those specifications with the IID kind of ignoring the long-term return properties. I think they kind of get back to all equity in late retirement, kind of 95 or 90 years old or something like this. They're kind of back to the all equity strategy.
Interesting. So it's equities, adding bonds at retirement, and then decreasing bonds slowly back to 100% equity later on.
Yep.
Yeah, interesting.
How does that change if only domestic assets are allowed?
Yeah. So just looking at like effectively excluding international stocks from the analysis. So now it's like, okay, if we want to diversify away from domestic stocks, now we have to go to fixed income. So that also increases the role for bonds and bills. In those analyses, you have some fixed income allocation throughout your entire retirement. The working years, we're still seeing 100% equity, even with just access to domestic stocks. But once retirement hits, you're always going to have some portion in fixed income. And if you kind of combine these two things and imagine that you're just looking kind of domestic stocks, bonds, and bills, and then you're also going to say IID. And this is a little bit similar to the setup of a lot of academic papers anyway. That you have pretty sizable fixed income exposure throughout retirement at that point. So at age 65, for example, you go from, in your working years, you're 100% equity. And then at age 65, you switch to 60% in bonds and bills and just 40% in equity. And so that really swings the analysis quite a bit.
Kind of takes you back to the status quo, I guess.
Yeah. And, I think we would argue on this. So in some sense, it's like, yes, our results are sensitive to this kind of block bootstrap assumption and the assumption of putting international stocks in, but it's like, but I have access to international stocks and we know that returns aren't IID. And so I feel like those are pretty easy, assumptions to kind of, get behind. So.
Yeah, it's sensitive to the assumptions, but if they're the right assumptions, then people should be sensitive to them.
Yeah.
Okay, so we had the time varying optimal portfolio that loads up on bills, 27% at retirement. And that was with a 4% constant spending. So that they're spending $40,000 in the first year if they have $1 million and then adjusting that for inflation every year. How does the optimal portfolio change when you switch from the constant spending to a proportional spending strategy?
Yeah, if you just spend, we're using 4% of wealth, but if you just spend 4% of your current wealth at all times and have that's going to fluctuate your consumption around a lot, but your optimal strategy at that point is 100% equity for your entire life. And it's almost completely flat in terms of the domestic international allocation. So it's like nearly identical to our fixed weight optimal strategy. So the blip is gone.
Mm-hmm.
Wow. So what is the interaction between that, the spending strategy and the optimal portfolio? What does that say about sequence of returns risk?
Yeah, I think with the 4% rule, so 4% rule is kind of as exposed to sequence of return risk as you can potentially be. And so I think the entirety of that blip where you're getting money into bills for the beginning of your retirement is just to reduce your exposure to that sequence of returns risk. And so you're trying to make a sudden drop in stocks less damaging to your full retirement. And I think that's driving the entire allocation to fixed income in the base case.
Yeah, I remember Michael Kitces had an article out a number of years ago about a bond tent, and it sounds like that's kind of it, right? It's just basically play defense for a couple of years in case you get really, really unlucky, but then the kind of glide path resumes back to 100% equity, right? And so sequence of returns risk, if I've understood you correctly, is largely solvable by variable withdrawals.
Yeah. Yeah, and there's a range of kind of hybrid things that people have done where you try not to have the extraordinary volatility of if your portfolio goes up 30%, you withdraw 30% more, but you also don't have such a rigid rule as is implied by the 4% rule, and so presumably there's a degree to which sequence of returns risk exists in things that are closer to the 4% rule, and it's probably going to be very muted in the things that are closest to the just totally variable rule.
Yeah, which I mean makes pretty good sense. Two different ways to solve the problem.
Mm-hmm.
Okay, how do the optimal portfolio allocations change when you allow the couple to condition their investment strategy on the domestic stock valuations, on the price to dividend ratio?
Yeah, so it's pretty common in this literature to think about like time varying expected returns and how would market conditions affect things. So our approach to it in the simulations is to basically we can give the couple information every month about like is the valuation high or low currently in the market that they're investing in. And we break it up into quintiles of the price dividend ratio, like the domestic price dividend ratio. So the lowest quintile with the low prices is roughly like less than 20 for a price dividend ratio. And then the highest is roughly greater than 50 for a price dividend ratio. So the US right now is in the highest uh, valuation bucket. I think a lot of the rest of the world is not right now. So in the middle three buckets, like the middle three quintiles, we get all equity strategy that's pretty close to just the unconditional base case, 33%, 67%. So it's really on these two ends. So if we look at the lowest valuation bucket, so domestic stock prices are low, the couple chooses to do 65% domestic, 35% international. So basically buy the cheap stuff locally and just reduce international allocation. In the highest bucket, I believe the numbers, it's 75% international. So you're really kind of upping your investment internationally. And then it's 16% domestic stocks and 9% bonds. So that's where the bonds finally sneak in. And we first, we see a little bit of bonds. If your domestic stocks are very highly valued, you get this, modest allocation to bonds.
Interesting. So that kind of speaks to some of the criticism from the first draft of like, writing this paper when U.S. stock valuations are as high as they are doesn't make any sense. But you've kind of addressed that now. Do you think that this analysis also addresses the idea that expected stock returns are just generally a bit lower now than they may have been in the distant past because markets have gotten safer or whatever?
Yeah, I mean, to the extent that the price dividend ratios now are like directly comparable to what they have been. I mean, obviously we've had some shifts away from dividends towards repurchases and things like that. So if we had all the data, we could probably turn it into like a payout ratio sort of thing. But I think it's probably the case that we're going to hang out a little bit more in the top three quintiles than in the bottom three quintiles, or at least, I mean, hopefully to some extent. I mean, that to get into that lowest quintile is not good times.
Yeah.
I suppose, kind of post financial crisis type of stuff was probably getting towards that lowest quintile in some of the countries. So
Yeah,
Yep.
that makes sense. So when you allow for this conditioning based on valuations, how significant were the gains for the optimal portfolio?
yeah, if we go back to the optimal savings rate, so if we have 10% saved in the fixed weight strategy, I mean, we've now given the couple more latitude and to optimize, so it's going to be better, and so they can get down to about 9.7% savings. So they get a decent gain, I think, out of that. We do some additional analysis just on like, is it the bonds that are coming in and saving it, or is it that domestic versus international allocation? And about 80% of the gain comes from switching across domestic and international, basically in those two extreme states, like betting on a lot on domestic when prices are low and getting the heck out of domestic when prices are high. That's where about 80% of that economic gain is from.
Interesting. So does that mean people should be conditioning their, like, what's the advice here, I guess? Should people actually be conditioning their domestic allocations on domestic valuations?
Yeah, I mean, I'm right now about 50-50 US international. I guess I just haven't really changed since the like our first draft that kind of had a 50-50 rule of thumb. Um, but so that means I'm underweight the US relative to market weights, and I think I'm perfectly comfortable being underweight in the US given US prices versus say like European prices right now. So on the other hand, like you look at all the academic evidence and kind of institutional performance management around trying to time the market, and I mean, it's not easy to do.
Yeah.
So
I guess the other interesting thing is, so you've sorted valuations into quintiles based on the full set of available information.
yeah,
Yeah. Okay. Interesting. But any investor today does not have the full set of available information. They have past valuations. They don't have future valuations. Your investors have past and future valuations. Is that right?
Yeah, so I mean, at any given time, we're just telling the investor like this is your price dividend ratio right now. So it will end up kind of mattering like, you know, how you're investing at age 75 does depend kind of, and the utility that you're getting does depend on the wealth that you built up over time. And so
Hmm.
it depends on your strategy performance and such up to that point. But I don't think we have like a pure like look ahead bias necessarily in terms of we don't tell the
Okay.
investors that prices are going to get higher than they currently are.
Okay. I'm just trying to think through that because if the valuations are organized into quintiles and so they don't know that they're in the which quintile they're in.
Yeah, they know which quintile they're in and what they so we're letting them optimize their their asset allocation within that quintile. Like if they're in that bucket, this is what they're choosing. They also know if in other years they fall in one of the other quintiles, they know what their strategy would be if,
Hmm.
you know, if they move from quintile 3 to quintile 5 and get into high price territory, they know that they're going to back away the domestic stocks a little bit.
Hmm.
So they're aware of how they will like we do the joint optimization across the five strategies. So they know how they will dynamically react, but they don't know what the future is going to look like.
Hmm. Yeah. Okay. Interesting. That's cool. That's a cool piece of analysis.
Nice.
Um, one of the other things that I've gotten kind of pushback on when I say that your methodology with the bootstrap makes a lot of sense is that some random small country that gets pulled into the bootstrap to represent a domestic country like Canada or the U.S. that it just doesn't make sense. So how important is the inclusion of small countries or countries with small stock markets to the main results in the paper?
Yeah, I guess we've heard this before too. We had a reader pretty recently that seemed pretty offended about Iceland being in the sample. So one of the things that we've done, we've looked at, say, just include large population countries as one way of splitting on this, and we've looked at 0.2% of the world and 0.5% of the world. And so for context, like Canada is like exactly 0.5% of the world. So it's basically like Canada and bigger countries. And if we just throw out all the smaller countries than that and redo the analysis, we'd get 27% domestic,
Hmm.
73% international, 0% bonds, 0% bills. So,
Crazy.
and some of the narrative around this too is like, well, of course, somebody from a small country is going to want to get most of their money in international. And it's like, well, the numbers, if we just look at the analysis, it actually is like going the opposite direction, where it's like the larger the countries, they're actually trying to do more international, and so
Hmm.
that sort of narrative doesn't really hold up in the data. The other thing that we've done, there are sort of differences across countries in kind of how important the stock market is, or the breadth of industries in the stock market. So we can condition on the stock market capitalization being at least half of GDP in a country. And like the US actually doesn't hit that until the 1990s, you know.
Hmm.
So it's a fairly stringent thing. And I think these screens kind of do the things that we're trying to do if we look at which countries are in the sample for which times. And that's also like 27% domestic, 73% international, 0% bonds, 0% bills. So I don't know. We've tried a lot of stuff, and people seem to think like just this little tweak of the data, and everything's going to fall apart, but it just doesn't seem to fall apart.
Interesting. Very interesting. So what happens if you take out Germany?
Yeah, so I mean Germany's another one of these little stories where it's Germany has hyperinflation following World War One. So 1920 to 1923 in particular, uh, bond returns look weird. Like there was, I mean, whatever it was, trillion% inflation or something like this. So bond returns look weird. So our summary stats on Germany look weird, and it makes our overall sample summary stats, if you did a standard deviation, it makes bonds look risky because we had really extreme returns in a couple of months in Germany. So, I kind of had the stance like it's obviously not one out of the 2,650 years worth of data driving our thing. And then Ben was like, well, I've heard it said by a lot of people, so you might as well just run it. So went ahead and ran it, and it's 34% domestic, 66% international, 0% bonds, 0% bills. If we just throw out all the data from Germany through the entire sample, just purge it from the sample.
Virtually no change.
Yeah.
Yeah, that's crazy. That's definitely a big one of the like, if you just change this one thing, I bet you the results will change. Yeah. And it's pretty funny that it doesn't. Not funny, it's like fascinating. Also funny though, because people are so sure that it's going to change the result.
Yeah.
What about all pre-World War II data?
Yeah, so the pre-World War II, I guess there's two concerns. It's like, one, we have some data from 1890, and is that comparable to today? And then the second, people seem to have think that war risk has gone away. Apparently, they're a little more optimistic than I am, but we can just drop everything World War II and before. And I forget the exact, I think it's 31% domestic, 69% international, 0% bonds, 0% bills. So it's just
crazy.
The same thing.
So nothing changes.
Yeah.
Virtually. Yeah. Just obviously changes. But
yeah, the big thing in terms of sample period is you need to have a long enough sample period where you're including bond market cycles. So, interest rates go up, interest rates go down. And so interest rates after World War II are roughly what interest rates are now. And we've had a couple of different interest rate cycles where interest rates go up, interest rates go down. If you were to say start the sample in 1980, when all the bond yields are at whatever 15 to 20%, bonds had good returns in the 40 years following 1980 because you get this enormous capital gain from yields falling from 15% to 5%. And so that's the data that a lot of people are used to looking at on bonds. Basically is like, well, the 80s was a good decade, the 90s was a good decade, the 2000s was a good decade, the 2010s was a good decade. But it's like, well, the 1970s were terrible and the 2020s have been terrible. And so if you're including a full bond market cycle, you have enough of the terrible bond stuff going on. And like we just can't get the same bond performance as we had since 1980 because if we're starting at 4% now, we have to go to like negative 11% or something to get that same set of capital gains. So
yeah, makes sense. So for international stock portfolios, how important is the inclusion of the U.S. market? Like if I'm in an international, if my domestic market is not the U.S. and I'm outside the U.S., how important is the U.S. inclusion in the international component for those investors?
Yeah, this might be about the biggest change that we saw on any of them. So like obviously the U.S. has been a big part of the international portfolio for quite a while and has had that good performance. So if you completely exclude the U.S. from the entire analysis, you get 45% domestic, 55% international, 0% bonds, 0% bills. So it still doesn't like international stocks don't become so bad that you're gonna go to bonds. You still want to diversify with international stocks, but instead of the base being like 33% domestic, it's like 45% domestic if you just take out, kind of the ex post winner of stocks over our sample. If you take that out, then the international stocks don't look quite as rosy, but they're still preferred to bonds.
It's incredible.
It's still crazy though, because that's another one where people are like, well, of course international stocks look good when you're including U.S. and international.
Yeah, it's kind of
that's true to an extent, but it's not that sensitive to that.
Yeah, it's kind of eye of the beholder whether the 45-55 result is very different from our base case or whether it's the same thing. I mean, because in
Hmm.
some sense it's kind of the same thing. Like it's it's a different allocation, but it's 100% equity with a lean towards international.
Yeah, and you talked earlier about how the utility is fairly flat within a pretty big range, so it doesn't sound like this is a huge deviation from that.
Yep.
Okay, another one that comes up a lot when I've talked about any of your research, like when I make a video about it, there's certain parts of the internet that get extremely upset with me because they think that the U.S. is special.
Yeah.
I mean, I hear that all the time, and therefore treating it like every other domestic country, the way that you do in your sample, is a mistake. How do your data change if the U.S. is in fact special?
Yeah. So there's certainly a view that the US is special and that the US being special is going to manifest in the US continuing to have high returns. And so the way that we can try to model this is okay, we have on the one end of the spectrum, we're not treating the US any differently. And that's our base case where we just throw it in there with all the other developed countries. So we're going to view this as like a 0% view on the US being special in this particular way. And so that's our base case analysis, 33% domestic, 67% international. On the other extreme, the US is special, 100% guaranteed, and future returns in the US are going to look like past returns in the US. So then we just use 100% the US sample to do the analysis. If you run that through, you get 100% domestic, 0% international, 0% bonds, 0% bills. You just throw it all in US stocks and you're good to go, right? So then what we can do in the middle of these two is basically mix the two. Like if you think about running a million simulations, you can run it where 90% of the simulations come from the US and 10% come from our full developed sample. So we're giving you a 90% belief at that point that the US is just going to be special and earn higher returns than the rest of the world. And so if you do that, you're already backing off just a little bit on the 100%. So you're at like 96% domestic, 4% international. And then, as you go, like if it's 50-50 on whether the US is special or not, then it's 60% US and 40% international.
Hmm.
And that's about the market weights right now, the world market weights. So in order to have like a home bias, like a bias towards, as a US investor, to have a home bias, you have to have more than a 50% belief that the US is going to continue to earn higher returns than the rest of the world effectively, which, there are certainly people who have more than a 50% belief uh, that this is true just from, casual observation of, things on the internet and conversations with various people. But
I know you didn't run it, but could you do the same thing for like, Canada up until sort of 2009, Canada and the US were pretty close. Like if we made a Canada is special case, would it have a similar effect, do you think? Or Australia?
I I would guess so. Yeah. I haven't run it for so like we haven't run it kind of country by country. It's potentially something to do to just see how much kind of variation there is across those things. I mean, it's always a little bit tough to like like I think to say that that means more to countries or to investors in that particular type of country. I think we would tend to argue against getting too granular in that,
Hmm.
where it's like, yeah, this country got unlucky, but is it a country that just gets unlucky,
Right.
or did it just get unlucky? I mean,
It, you said earlier that people have to believe that the U.S. is special and that's going to manifest as higher future returns. What would be, how else could that manifest?
yeah, I mean, like if the US has structural advantages and, people will talk about innovation and different institutions and all this sort of stuff. I mean, an alternative is that we just have higher prices and if anything, lower risk premiums, so lower future expected returns. And that would be kind of consistent with, there's evidence by Bauman and French and Avdis and Walker that a lot of the a couple percent of the historical US average return was just the increase in valuations that we had. And it's possible, there's a paper that's now forthcoming at the Journal of Finance by Bensbergen, Hua, Peters, and Walker. And in their model, have a theoretical model, and their investors are learning about the probability of crashes, essentially like disasters in each country. And over the sample, they become convinced that the US is different from many of the other countries. But now those investors would just price the US higher and have a lower risk premium because it's not as risky. And so they believe, the investors in their model would believe that the US is special, but they believe that warrants a higher price and lower returns because of the higher price. And that seems much more like that seems like an easier equilibrium argument to make, that's how it would, like to say that all the institutional investors in the US think that the US is special, and so they're all overweighting the US, and then that doesn't have an impact on the valuations that's going to kind of hurt future performance. So I think the rationale for the US is always going to earn higher returns is just pretty tough to figure out how that's going to work.
Yep. Yeah, it's crazy because it's like the opposite of what people think. People think that it's special, therefore it'll have high returns, but in reality, it may be special and therefore have lower returns because it's a safer, higher quality market, which is true, but that doesn't mean it's going to have higher future returns.
Yep. I've said that for a long, I don't know. I got it from you, Ben, I think a while back, or from maybe one of your guests, but yeah, if it's the biggest, safest market in the world, why would you expect higher returns from that? Right. Okay. So how important are the relatively low historical correlations between domestic and international stocks? How important is that to the performance of the optimal portfolio?
Yeah, we've seen the domestic international stock correlation kind of vary across time. It's gone up, it's gone down, it's gone back up. It's relatively high right now. If you look over kind of like shorter periods, and I haven't done this super formally, but it tends to be the case if you're looking at the US correlation with international stuff, it tends to be pretty high most of the time. And then there are just these little periods where it's like 0% correlation or negative correlation for just a short period of time. And then it kind of goes back up to very high correlations. So, it'll be interesting to see whether we're just in a high correlation regime now, and it's less likely that we do that kind of switch, or if it's just one of those hasn't happened in a little while. But one of the things that we can do, and we do this split where you take your retirement periods. I think we focused on retirement periods, but you take the retirement periods and you can split that into quintiles based on the realization throughout your retirement of how high is that correlation between domestic and international. And then you can look at the low correlation regime versus the high correlation regime. And the stock strategy is still the best across all of those, or like of the strategies that we consider, it's still the best strategy across all 5 buckets. So one of the things that we see is that we're looking specifically at the probability that you run out of money in retirement. And in that high correlation bucket, so this is very high correlation across all world markets, all of the strategies have very low ruin probabilities. In the low correlation, we see much more spread. Like ours is kind of the least sensitive to the correlation, but some of the other strategies get really bad when the correlations are low. So my guess is that the correlation across markets is some sort of proxy for whether it's worldwide macro stuff, or whether it's war stuff, or whether it's trade stuff, or I mean, there's all kinds of things that could be going on to kind of drive wedges between different markets in the world. But I think most of those wedges are probably bad wedges. And so there may be a degree to which it's like high correlation is going to hurt the diversification benefit of domestic stocks versus international stocks. But that may be the state of the world where there's not as bad of a set of risks. And then in the times when the world is a little more like risk laden, there's going to tend to be lower correlation and you get more of the diversification across international markets. It's a little tough to exactly tease that out on what's driving that result, but that's kind of my sense.
Yeah, super interesting. Those are the two probably like most intelligent pushbacks that I've seen against your paper are the valuations, like current valuations are higher than a lot of the sample, therefore it's not valid, or uh, correlations. So valuations, correlations, but you've addressed both of them, I think, pretty well in this version. Uh, what about labor income? How does an increase in correlation between labor income and domestic stock returns affect the optimal portfolio?
Yeah, so there's a lot of disagreement in the literature on exactly the extent of this correlation. So we've had everything from, some of the older literature was basically saying that there would be effectively zero correlation between labor income and stock returns. Uh, there's others that, depending on kind of how you're splitting workers on education levels, income levels, things like this, there's a set of workers, and probably, realistically, like the most likely retirement savers are probably on the higher end, maybe like zero point 0.3 correlation or something like this between the labor and the stock market. So we look at a range of everything 0% in the base case, but everything up to 0.5%. And and basically, you do that, the investors are going to get away from domestic stocks a little bit because they're already exposed to that correlated risk with their labor income. But they never run to bonds. They just put more internationally and
Hmm.
diversify a little bit more that way. So effectively, their labor income becomes a little bit domestic stock like, and so they already have a bit of that exposure, and so then they just go more towards international stocks. But uh, and it's like the pattern turns out to be reduce the weight in domestic stocks by 3% for every 0.1 of correlation. So
Hmm.
Okay. So your paper talks a lot about leverage as well. So I want to switch gears a little bit and talk about leverage. So the base case has a no leverage constraint. How do the optimal portfolio results change when you allow for leverage?
yeah, we've kept no leverage as a base case because I don't know. I guess outside of some of your listeners, I don't know a lot of people who are levering up their retirement savings, and like within the actual retirement accounts, you're typically restricted from doing a lot of this stuff. So we're kind of trying to write to just the average person who's picking a default fund in their retirement account and probably isn't trading futures or anything. Uh, but if we do introduce leverage, it tends to be the case kind of depending on risk aversion and depending on how expensive the leverage is. We do see them, our investors wanting to take on some leverage. So one of the issues around leverage is kind of figuring out what's the cost of leverage. We do, I guess, three different approaches. One's like very high cost of leverage, but I mean, I have an E-Trade account after about 15 different mergers or something like that, and I looked it up yesterday, and they would charge me, I think, 12% for margin. And so, there's that on the one extreme. We have kind of a middle ground of 1.4%. That's the lowest margin rates that we could see. And then if you go into derivatives markets, there's a paper by Binsberg and Diamond and Groteria that they estimate the risk-free rates that are implicit in like futures contracts. So what's your implicit borrowing cost if you're trading in futures? And that's about 0.37% above treasury bills. So that's kind of the lowest spread that we consider. Uh, we talked to another like large asset manager uh, in Europe about this, and we're kind of asking them like what their clients do, and they're talking about like the Lombard loan market, and then we kind of asked the question like what happens around like financial crisis or something, and they're like, yeah, that market dries up and you can't borrow. So we're kind of assuming that away and just saying like, hey, regardless of the market, you're not going to have to kind of like reverse out of your leverage at the worst possible time. So I think we're given pretty favorable conditions, at least at the lowest leverage cost level. I think it's pretty favorable conditions, or like giving leverage the benefit of the doubt.
How important is the cost of leverage to the optimal use of leverage and the optimal levered portfolio when you model it out?
Yeah, it's very sensitive. Like nobody wants to pay 12% margin rates. So that couple is 0% leverage, and so they're like the no leverage constraint is not binding. So they pick the same optimal portfolio as in the base case at kind of the medium, like 1.4% spread above treasuries. So that's again like the lowest margin rate that you're going to be able to get on your own. That they choose 55% leverage, and they invest 34% domestic, 66% international, 0% bonds, 0% bills. So it's effectively the exact same portfolio, just levered up. At the very low cost of leverage, like the 37 basis points, they do 100% leverage. We do cap them out at 100% leverage. They do 100% leverage. And I think that one is, let's see, I think it's 15% in bonds at that point. So the rest is split across domestic and international stocks in about the proportion that you would assume. But at 100% leverage, they are finally going to start getting some bonds in there.
So with some of these products that are available out there, there's leverage inside the product itself, right? And you're going to have to pay a fee on top of the borrowing costs for that. So how do you think the product fee for a fund using leverage should be accounted for in the total cost of leverage?
Yeah, so a lot of these funds, they're actually going to be able to access something like this 37 basis point spread if they're using futures or other ways of borrowing. They're probably within the fund being able to do that. So then there becomes this issue of management fee plus borrowing cost. And I think a good comparison is I can be unlevered in a passive fund for like 2 basis points. So then what's it cost me to lever? And as soon as you're doing leverage, now you have to have active management. Like the leveraged ETFs do daily rebalancing. Like you if you're going to maintain a specific leverage level, you have to trade every day. And so you're going to have to pay somebody to do this. I don't think anybody's doing this on their own. And so if it costs me 1% to invest in that, and then 37 basis points within the fund for leverage, that's 1.37%. Our middle case is 1.4%. I think it's effectively getting us to about the same place.
So in that middle case, it was 55% leverage or 155% exposure to the same optimal portfolio as the base case. So does that suggest that, at least based on that analysis, people should be optimally using some leverage in their portfolios?
Yeah, I mean, if they have access to that
medium cost, right?
Borrowing cost, then I mean, I think this is going to depend on risk aversion too. Like actually at that lowest or at the medium borrowing cost, if you have low risk aversion, you're still 100% equity in there. So it just sort of depends. I mean, I don't think I am personally going to go out and start levering up, but if somebody has the risk tolerance for it, then I suppose our data are suggesting that there is a strong enough, return reward for taking on the risk that you're not crazy for doing it. So
it's a dangerous thing to say. We once did an episode years ago on leverage and talking about how a lot of models suggest that it is optimal, particularly for younger investors. And man, people went like pretty crazy over it, for lack of a better word, where all of a sudden everybody that listened to our stuff wanted to use leverage, and we're like, whoa, we weren't
Yeah.
necessarily saying that you should do that.
Yeah. Yeah. Like, I think this is one of those things like we all, we all have some kind of like prior beliefs on things. And I guess I have a pretty strong prior that I should not be levering up my retirement savings. And that's going to be strong enough to outweigh any of this other evidence. And then, I do think kind of coming back to this unmodeled aspect of it where, what happens if your leverage channel
Mm,
dries up in the financial crisis? I mean, that's what happened in the financial crisis to everybody running these leverage strategies on mortgage backed stuff, right? Like this is when credit disappears. And if you have to unwind your two times levered equity position in whatever, late 2008 or early 2009, I mean, then you miss out on the bounce back. So I think that, perhaps as another argument for maybe don't take that part quite so literally, like I think that is a risk. And that seems to be, I mean, that seems to be a risk that like large institutions are internalizing that risk when they're doing arbitrage strategies and things like that they're just liquidity dries up and they have to get out at the wrong time. So I think levered investors are going to face that same sort of potential issue.
mm-hmm. Yeah, we had talked years ago to an asset manager who was building concentrated portfolios to try and get access to higher expected returns. And their reasoning was that like leverage in bad times really, really sucks. So if you have to choose how to get higher expected returns, you're better off concentrating in higher expected return assets than you are levering up lower expected return assets for the exact reason that you just said. So I think that is knowing that is an unmodeled risk to get to that result is pretty a pretty important piece of information for people listening.
Yeah.
Yeah, good point. Okay, so we're talking about this kind of optimal levered strategy, right? In the kind of the middle case, I think you said it was the spread was 1.4% above treasuries. In that scenario, how significant were the gains of that optimal levered portfolio versus the optimal unlevered portfolio?
So I don't think we've run that number specifically. Uh, I was kind of eyeballing the expected utility, and I've got a pretty good sense for these things. I think it would turn out to be around 8.8% or so for an equivalent savings rate. So I think they're perceiving an economically significant gain from this. So, that's but subject to the caveats that we just went through.
Yeah. What about the levering up a 60-40 portfolio? How would that compare to levering up the optimal levered portfolio?
Yeah, so that's a common argument is that you shouldn't be 100% equity. You should be like do the 60-40 and get leverage. So comparing the 55% leverage with all equity and the 55% leverage with 60-40, the 60-40 strategy, you have to save like almost 25% to match the utility of 10% in the other one. So there's a very large difference,
Hmm.
very large.
Mm-hmm.
Okay, so then, so from there, how does the levered 60-40 portfolio compared to the base case unlevered optimal portfolio?
Yeah, so this is the trade-off between being just 100% equity or using the 60-40 and getting leverage to try and take advantage of whatever diversification benefits you get with bonds. But when we run that, it's relative to 10% in the base all equity strategy with no leverage, you have to save 19% in this levered 60-40 strategy. And it's a little bit sort of counterintuitive because like once you lever up the 60-40, you actually hold like almost 100% of your wealth in stocks and then you own bonds on top of it. I think it's the rebalancing where you just keep on taking like throughout your entire life. stocks are giving you these gains, and you keep on taking these gains, and you just keep on throwing them into bonds, and then the
Huh.
bonds aren't doing anything for you. And so if you were to run just like a no rebalancing, that would just get you back to an equity dominated portfolio pretty quickly. Then that would have like a much lower, you know, I guess equivalent savings rate, but that's not what the 60/40 strategy is. The 60/40 strategy is like, yeah, you got to get away from expensive stocks and into the bonds and everything. So yeah, our investors just really don't like the prospect of having 40% invested in bonds.
Mm.
Yeah, that's a crazy result. Because like you said a minute ago, Scott, that's like what people say. You shouldn't be 100% in stocks. Instead, you should lever up a 60/40 portfolio to get to the same expected return level with more diversification. But your findings kind of show maybe not.
Yeah.
What do you think that specific finding says about, mean variance, traditional mean variance, monthly return, annualized monthly return type thinking, where you do want to lever up to the maximum Sharpe ratio?
Yeah. So, I mean, Sharpe ratio like has a nice grounding in historical, finance and everything. But I think you were talking to Hank Bessenbinder about similar issues recently. He's also thinking about long-term returns, and by the time you get skewness in there and everything like that, it's like, well, Sharpe ratio is not necessarily telling you the whole story. I think one way of thinking about it is, there's a couple ways to get into kind of CAPM world, mean variance world. One is to have mean variance preferences, which is, Markovitz started us off there. But another way to get into mean variance world is to have normally distributed returns, because with a normal distribution, it's kind of the mean and variance are the only thing. There's no skewness, there's no excess kurtosis. It's only mean and variance. And so in that sense, picking the best, set of mean and standard deviation that gets you the best distribution. Like those two things define the distribution, and it gets you to the best distribution. So the best Sharpe ratio is the best normal distribution for investing. And if we're thinking about our stuff, now we're thinking about long-term return distributions. In some sense, our investors are still just looking for the best distribution. It's just that the Sharpe ratio is not going to define what the best distribution of returns, even our retirement wealth, that's after 40 years of investing. So there's going to be huge skewness. A Sharpe ratio penalizes the good outcomes on the right tail just as much as it does the bad outcomes on the left tail. It's it just treats things symmetrically, and so like a Sharpe ratio doesn't really apply very well over longer horizons. Um, and so I think kind of recognizing that, people have tended to apply Sharpe ratios to monthly moments, like monthly return moments. But that gets you back to this problem where at a short horizon, bonds look like they're diversifying you a lot. And then over long horizons, they're really not. And that's just very tough to reflect in like a Sharpe ratio framework.
Yeah, makes a lot of sense. Okay, so how sensitive are your results or the results throughout the paper? How sensitive are they to risk aversion?
Yeah, so kind of the headline results are not that sensitive, and it just goes back to this, so our investors are going to be optimizing utility, and utility, considers the whole range of outcomes, and utility actually really penalizes bad outcomes quite a lot relative to like what a Sharpe ratio would. Uh, but they're just looking for the best distribution, and the stocks, like the all equity portfolio, just has the best distribution, and it's not like, oh, we're doing this trade-off between the upside potential and the downside safety. If it's winning on both, you're just going to get that same result for like every set of investors that look at it. They're like, yeah, that's a better distribution. So like the very risk averse investors are going to place a ton of weight on that left tail, like the bad outcomes, but they're coming up with the same answer as the very low risk aversion investors that are like, look at all this upside that I can get. And so if those two investors they're coming to the same decision for different reasons, but they're coming to the same decision. So the places that we see risk aversion mattering more is things like leverage and, some of the, if we start kind of relaxing some of those constraints, you see a little bit more of an effect. But, kind of the headline results, the all equity is not really that dependent on risk aversion.
How has the response been from both academics and practitioners since you released the very first draft of this paper?
Yeah, so I would say that we've had a lot of people very interested. I mean, it is a topic that people are interested in, excited about. We've had a lot of very helpful comments, and nearly everything that we've done is in direct response to somebody's feedback, and the design of some of these things are based on conversations with other professors and Ben. So like that's been great. On the other hand, it's been a little bit weird where there's been, I would say like a few folks talking very publicly about the paper with kind of criticisms that we're just not really sure where they're coming from. And it's not clear that they've really looked closely at the paper and thought about what we're doing in making some of the criticisms. Ben's been my sanity check on a few of these things as well. And we like I think people just feel very strongly about this, and they have strong views. I mean, we had a recent discussion at a conference that was, I think, I'd say like misreporting numbers that are in the paper to basically try to make the paper look like less conceivable or like tougher to believe. And it's just I don't know, it's been like some odd behavior where I think in academia we're used to arguing about stuff, but it's good to like argue about the facts and like if you don't like one of my assumptions, that's cool, we can talk about alternative assumptions and everything, but that's kind of where we prefer the conversation to be. So again, we've had lots of good lots of good, very helpful people, and received unsolicited feedback from like we got unsolicited feedback from John Campbell, which was really cool. So we've got lots of really helpful people. So
It is a topic that people get. I mean, I think this is the right word. They get very emotional about, which is interesting.
Yeah.
Well, it kind of flies in the face of a lot of what people intuitively believed, right? If you think about like Ben and I, what we do for a living, I think, and maybe just in Canada, but in a lot of places, the sort of glide path portfolio or the kind of 60-40 model. I mean, if you've been doing this for 25 years and you've been putting your clients into that, and then here's this paper that kind of says, well, actually you were wrong. Like you're probably going to be critical before you actually do the work to do an about face with your clients, right?
Yeah. Yeah. I think even with professors, when we present this, when you run across the people who are already 100% equity, and it's not trivial, the number, but they all love it because they're like, you knew I was right.
Yeah.
But it just goes back to like everybody already knows that they're right on this thing.
Yeah.
And then it's very difficult to like shift the priors, the prior beliefs with new evidence. So.
Oh yeah, it's confirmation bias all the way down, isn't it? So as you've been taking all this feedback and comments and criticism and kind of refining and improving the paper, has anything about the additional research and findings surprised you?
I think it was just sort of the cumulative effect of just how resilient the results are. When it's just like, we just got to a point where it's like, we'll run it. We know what it's going to look like, but we'll run it.
Nice.
Okay. There stopped being surprises like pretty early on. So
It is surprising though, because there's so many things where it's like, I wonder how different it would look without Germany, or I wonder how different it would look excluding everything before World War II.
yeah.
Yeah, I agree that the resilience of the kind of general findings are pretty surprising, and valuations too. Like all those things are like, yeah, that plausibly could change things quite a bit.
Yeah.
Yeah, very interesting. So what's next for this thing? Like, I know you've been doing conference presentations and stuff like that, but like, does this go to journals? Like, what happens next?
Yeah, I mean, we always kind of had a long runway with this paper. We felt like we wanted to make sure that we got comments and just address all the criticisms and everything like this. And so we've gotten a ton of feedback. We've made a ton of changes. Uh, we're ready to start taking our shots. So we'll start submitting to the journals. Like at the end of the day, as academics, like the only thing that we get rewarded for is publications in top journals. And so that's what we'll try to do.
So you just go submit it to top journals and see what happens?
Yeah. Yeah. We just have to get, a set of referees and editors that are not particularly grumpy and, you know, see how it goes. So, I mean, it's pretty brutal just because of the average rejection rates at these journals are all, over 90% basically. And so, you kind of work on a paper for 2 or 3 years, and then you have a very limited number of, unconditionally small probability things that you're chasing. So
Crazy. Well, I obviously hope that all goes well, because I think I personally, and I'm not an academic or a referee at a top journal, but I think this is really good paper.
thank you. Yeah, cross our fingers.
Yeah. All right. Well, Scott, thanks again for coming back on the podcast. I think, like I just said, it's a really cool paper. And I think the way that you guys have addressed all of the feedback and criticism and questions that have come since the first draft is like, I mean, it's the right way to address it. You went and modeled all of it and showed that the results are pretty resilient to all of the what ifs. So I think that's really cool to see. And I think people are going to continue, people who are managing their own finances and thinking about this, like you've seen the response in the rational minded community. I think your episodes and any discussion related to your paper are some of the biggest topics in the whole community, because it's so practically relevant to somebody who's managing their own money, or for Mark and I who are helping other people manage their money. So I think that you've made a big impact there, and it's pretty cool to see the paper continue to get better.
Yeah, thank you.